Every single point in your account could be worthless by the end of 2026. While you're planning your next vacation, Washington is voting on a law that could wipe out travel rewards forever. If you don't change your strategy now, your Chase, Amex, and Capital One points might just become digital dust. This isn't a scare tactic, it's a very real possibility based on legislation moving through Washington right now. The time to understand the threat and act starts now. To understand why your rewards are in danger, you need to understand the hidden mechanism that pays for them: swipe fees. It's a cost embedded in the price of nearly everything we buy. Every time you use a credit card, the merchant doesn't keep the full amount. A small portion, called the swipe fee, is deducted. On a $100 purchase, that's around $2 to $3. These fees are set by the major card networks, a market dominated by Visa and MasterCard. They control about 85% of the market, giving them immense power to dictate rates. While merchants pay the fee, the cost is baked into their prices, so you ultimately foot the bill. So where does this money go? The largest share goes to the bank that issued your card, like Chase or Capital One. A smaller portion goes to the card network and payment processors. For the issuing banks, this is a massive revenue stream. And critically, this is the very money that funds the generous rewards programs you enjoy: the points, the miles, and the cashback. Now, a new piece of legislation, the Credit Card Competition Act, aims to drastically cut that revenue by forcing more competition, which would drive down the fees merchants pay. The goal may be to lower costs for businesses, but it directly threatens the rewards you've come to rely on. Let's be clear about one thing: credit card rewards are not a magical gift from your bank. They are a carefully calculated, brilliantly effective business expense. There's no such thing as a free lunch, and there's certainly no such thing as a free first-class flight to Japan. Banks aren't giving away free flights and hotel stays out of generosity. They are incentivizing your behavior. Every time you see a tempting offer for 5x points on groceries or 100,000 bonus points for signing up, it's a strategic move to win your loyalty and, more importantly, your transaction volume. They offer these incredible perks to get you to use their card more, because the more you swipe, the more they earn. Every single time you tap, swipe, or insert your card, the merchant pays a small percentage of your purchase to the bank that issued your card. This is the interchange fee, the engine that powers the entire rewards ecosystem. For example, if a bank collects around 2 to 3% in these fees on your transactions, it can easily afford to give 1 to 1.5% back to you as points or cash back and still make a healthy profit. The remaining margin isn't just pure profit. It covers essential operating costs, sophisticated fraud protection systems that keep your account secure, and the bank's bottom line. This simple but powerful model fueled a fierce arms race among banks. To compete for your business, they rolled out massive sign-up bonuses, incredibly generous spending categories, and built valuable networks of airline and hotel transfer partners. For the last 2 decades, consumers have been the undisputed main beneficiaries, turning everyday spending into dream vacations. And it's not just about points. This swipe fee revenue also subsidizes a suite of valuable benefits you might take for granted: travel insurance, purchase protection, extended warranties, and airport lounge access. So what happens if that swipe fee revenue is suddenly and drastically cut? Banks will be forced to reevaluate every single expense. In this new reality, points become less valuable, and the perks we rely on could vanish overnight. The rewards landscape before 2026 has been rich and constantly improving. The future landscape, however, could mean thinner earn rates, smaller bonuses, and significantly weaker perks. Remember the numbers driving this model, because they are about to be fundamentally altered. Now here is how the Credit Card Competition Act changes everything. Let's dissect the proposed legislation that could dismantle the rewards ecosystem. The Credit Card Competition Act of 2026. On the surface, it proposes a simple, radical change. The law targets the largest banks, those with over $100 billion in assets. The core mandate is this: these banks must enable at least 2 unaffiliated payment networks on every credit card. So, while one network can be Visa or MasterCard, the second must be a competitor, like Noise or Star, networks with historically lower fees. This gives merchants the power to choose which network to use for each transaction. Naturally, they'll route payments through the cheaper option to minimize their costs. This is designed to ignite competition and slash swipe fees, with sponsors estimating it could save merchants $17 billion a year. But here's the devastating catch. By forcing merchants to route transactions to the lowest cost network, the law guarantees a race to the bottom on fees. For banks, this is a direct hit to their bottom line. Interchange revenue, the very money that funds the reward system, would plummet. Let's be clear, the mechanism that funds your travel points is the direct target of this legislation. The future it creates is bleak for reward collectors. Expect modest bonuses, drastically lower earn rates, and devalued transfer options. That 100,000-point bonus for a flight to Europe. In a post-CCCA world, it might barely cover a one-way domestic flight. The time for complacency is over. The window to maximize your value is open right now, but it is closing fast. If the Credit Card Competition Act passes, the world of credit card rewards will change dramatically. Earning rates may drop, even to half a point per dollar. Sign-up bonuses could shrink or disappear. Generous category bonuses could give way to flat, lower earn rates. Transfer, partner value could fall, and partners may be removed. Annual fees rise as banks shift costs to consumers. Expect new fees for services that were free. Banks will protect margins. Consumers will pay more. Millions could hold accounts full of devalued points. Preparation now is the antidote. Use a simple color lens. Protect gains. Avoid red losses. Here's how to shield your points, step by step. Your shield against devaluation. Simple steps to protect your points. Given the threat, sitting back isn't an option. Start by taking a full inventory. List your cards, balances, and key transfer partners. Points parked in bank ecosystems are vulnerable to devaluation. Move flexible points into airline and hotel loyalty programs. Think partners you'll actually use, like United Mileage Plus or World of Hyatt. Match partners to your home airport and usual destinations. Once transferred, partner rules govern your points. But hear this warning loud and clear. Point transfers are irreversible. Once you send your points to an airline or hotel, they can never be moved back to your bank account. You are committed to that program, so only transfer when you have a specific booking in mind. Don't hoard flexible bank points. They melt. The best way to lock value is to use your points, flights, and hotels. A ticketed award or confirmed reservation locks the value. Convert points from a fluctuating digital asset into real experiences. Don't wait for the perfect deal. Book before your points lose power. The crucial choice: transfer partners versus statement credits. When you redeem, you generally have two main paths. 50,000 points might get a $500 statement credit, a fixed 1 cent per point, transferred to an airline. The same points could buy a $2,000 flight, 4 cents per point. Those outsized values are precisely what's under threat. Transferring now can lock you into a partner program, assuming it remains stable. Statement credits are safe and guaranteed. No award searches or blackout dates. Choose based on your goals and risk tolerance. If you travel and know loyalty systems, transfer. If you want certainty or need cash, take the credit. The key is to choose, not to let your points idle and erode. At CardVantage, we upload new money hacks every Thursday. Subscribe so you don't miss the next travel loop. What to expect from banks as the landscape shifts. Banks won't absorb the hit. They'll protect revenue and margins. Expect higher annual fees, even on mid-tier cards. Look for a la carte perks, base cards plus paid add-ons, tighter requirements, higher minimum spends, and shorter windows. Caps on bonus categories and total earning, new or higher fees, foreign transactions, balance transfers, even inactivity. Stricter enforcement, including clawbacks if you close early. Read every notice. Be ready to adapt fast. A final warning and a path forward. The Credit Card Competition Act threatens the economics behind travel rewards. Banks won't eat losses, they'll gut rewards, raise annual fees, and cut benefits. You are not powerless. Move flexible points to trusted partners, and book important travel now. Review accounts. Make a plan. Execute without delay. Even if the CCCA fails, issuers are already shifting to consumer-paid models. Plan now. Transfer what you can. Book what matters. This content is for educational purposes only. It is not financial advice. Make decisions based on your own situation and research.